In this video, I discuss 5 highly effective Social Security planning tips to optimize your payment. Coming up next on Holy Schmidt.
Holy Schmidt!
Social Security can be confusing for a lot of reasons. One of the biggest reasons is that there is a lot of stake if you get it wrong. There are also a lot of moving parts like claiming options, sequencing benefits, maximizing the survivor benefit, and much more. This video discusses all of this in plain English to help you make better decisions. All right, let's get into it. But before we do, I have a little mind bender for you. What gets wetter and wetter the more that it dries? I'll give you the answer at the end. All right, let's go. Let's start with an easy one that you probably already know, and that is using time to maximize the benefit for the primary insured. I can't film a video on optimizing Social Security without at least mentioning this point. For every year that you wait to collect Social Security past age 62, your payment goes up between 6 and 8% per year, capping at age 70. It doesn't go up past age 70. If you wait past age 70, you're actually leaving money on the table. Using a traditional break-even analysis, if you're going to live past age 78 or 79, you're better off waiting to collect Social Security until your full retirement age. If you're going to live past 82, then you're better off waiting to collect until age 70. This assumes that you're trying to maximize your own benefit and not trying to coordinate your benefit with something like a spousal benefit or dependent benefits. We'll talk about the spousal benefit shortly. It's also important to note that maximizing your Social Security benefit is not the same thing as maximizing your retirement. This video is about income planning, but many of you won't wait to age 70 because you're ready to retire now and you're ready to collect Social Security either now or in the not too distant future. This is an entirely personal choice and no one should judge you based on your own decision. By the way, if you're in average health coming up on age 62, the average male lives to approximately 82 at age 62, and the average female lives to age 84. These come from the longevity tables and they are based on averages, but here's the problem. Nobody really knows for sure, and frankly, most people aren't average. Some will blow right through those numbers and live to be 90, 95, 100, and others will struggle to get there. And while no one can tell you for sure what your final day is going to be, there are apps and programs out there, software out there, that you can look at to give you an estimate, an educated guess. If you want an estimate, there's a website that offers this for free. It's called blueprintincome.com. I have no affiliation with it other than the fact that I like the website. And at blueprintincome.com, you can input your own information and it will give you an estimate of what your longevity should look like, could look like anyway. But maximizing your own benefit is not the only consideration if you're married or if you have underage children. You need to focus on considering anyway maximizing the survivor benefit. Because of the way Social Security is structured, the survivor gets either their own benefit or their partner's benefit, but they don't get both. So if you're the primary insured and you want to ensure, no pun intended, that your spouse has a larger benefit based on your earnings because he or she is the survivor, you might want to wait even up to age 70 to ensure that the benefit is as large as possible. The next point is maximizing the spousal benefit. On the flip side, if you're the spouse, you can only get up to 50% of your spouse's primary insurance amount. And there are 2 confusing points to this. The first is if the primary insured takes Social Security, does the spouse get a reduced benefit? The answer is no. Their benefit is based on when they claim. The spousal benefit is based on when the spouse claims, not when the primary insured claims. So even if the primary insured claims their Social Security at, say, age 62, they'll get about 70% of the PIA, the primary insured amount. The spouse can get up to 50% of the primary insured amount by waiting to their full retirement age. Let's assume that's 67 for this discussion. But here's an important point for the spouse. Waiting past age 67 will not increase their own benefit. So at age 67, you've topped up the spousal benefit, so that is the time to claim, unless, of course, the primary insured has not claimed their benefit, because the primary insured does need to claim their benefit before the spouse claims his or her benefit. And this is clearly a coordination of benefit question, not maximizing an individual spousal benefit or primary insured benefit question. The next tip is on how to minimize taxation on Social Security, perhaps even eliminate it completely. Before 1983, Social Security was not taxed, so that creates a lot of confusion in folks' minds. Even to this day, many people think that their Social Security payment isn't going to be taxed. So what triggers tax on Social Security and how do you avoid it? Well, I'm going to make this very simple. It's based on just a few things. Anything that increases your adjusted gross income has the potential to cause your Social Security to get taxed. I'll explain the thresholds and how they're calculated in just a moment, but let's talk about what increases adjusted gross income first so that you know if the activities that you're engaging in will put you at risk of having your Social Security taxed. Well, earnings from a job, of course, but let's assume that this isn't an issue for most of you. Pension payments, distributions from a 401k or an IRA, dividend payments, business income, and capital gains are all captured under adjusted gross income. What about a payment from a Roth IRA? The answer is no. What about the return of an investment that you made and simply just the return of the investment without any growth? Again, no. Think about if you bought stock in a traditional account, like a Schwab account, for example, a traditional trading account, not a tax-advantaged account like a retirement account, and the stock didn't go up in value, or worse yet, it went down in value. Then when you sell it, you won't have any reported gains and you might even have a reported loss. If it earns some return, then part of what you receive back is a return of your capital and part of it is a return on your capital. If you buy an annuity for $10,000 and you receive $1,000 back per year for 20 years, part of that $1,000 payment will be a return of your capital and part of it will be a return on your capital. The part that's a return of your capital is not part of AGI. The part that is a gain on your investment is part of AGI. You get the point. You won't have to guess which is which, by the way, because the company that sold you the annuity will provide you a statement at the end of the year, highly likely anyway, and it will break out what was a return of your investment and what's the return on your investment. Once you have your adjusted gross income, then you need to determine what part of your Social Security is taxable, and you need to use something called the provisional income formula. You take your adjusted gross income plus 1/2 of your Social Security payment and any tax-free interest from municipal bonds. You add that together and you're going to come up with a number for the year. That's your provisional income. If your provisional income is below certain thresholds, then your Social Security payment is not taxable. If it's above them, it may be taxable. Now let me explain what these thresholds are and how they work. If you're single and your provisional income is between $25,000 and $34,000, then up to 50% of your Social Security payment may be taxable. If it's over $34,000, then up to 85% of your Social Security payment may be taxable. If you're married and your provisional income falls between $32,000 and $44,000, up to 50% of your Social Security may be taxable. Over $44,000, then up to 88% may be taxable. I use the term may be taxable because the SSA runs your provisional income through 3 different tests and they give you the benefit of the doubt if you pass, so to speak, any one of the 3. However, it's safe to say that the higher your provisional income is above these levels, the more likely it will be that a portion of your Social Security payment is going to be taxed. And as it relates to tax, there are other ways to reduce your Social Security tax beyond just provisional income. One is avoiding states that tax Social Security altogether. Let me explain. There are 12 states that tax your Social Security benefits. They are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, and Vermont. But not all states tax Social Security equally. For example, Colorado has a tax deduction if you do in fact pay tax on your Social Security to the federal government. On the other end, Vermont, one of the 12 states that does in fact tax Social Security, is also one of the top 10 states in the country for state income tax at 8.75%. It's one of the highest. 8.75% is their maximum tax rate, and they do have exceptions for low-income earners, but their definition of low income and yours may vary wildly. There is one thing that's obvious though, and that is taxation at the state level for Social Security is declining. There were many more states 10, 15, 20 years ago that taxed Social Security than there are today. And while we're on the subject, Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming don't have state income taxes at all. The next point is knowing how much you can earn without having to give part of your payment back. In fact, I have a whole video on this subject alone. It's important to note that the Social Security Administration doesn't really want you to work a good paying job and draw Social Security at the same time. I could construct an argument why this is entirely unfair. I could also construct one why it's entirely reasonable. But the reality is, it's not negotiable, so we just need to manage around it. In 2023, if you're working while collecting Social Security and you're under full retirement age, you can't earn more than $21,240. That's $1,770 per month. If you earn any amount above $21,240, you have to return $1 for every $2 you earn in excess of this amount. If this is the year that you reach full retirement age, you can earn $56,520. That's $4,710 per month. The SSA requires you to give back $1 for every $3 that you earn above this threshold. Once you reach full retirement age, you can earn as much as you want, and the SSA doesn't require you to give any of it back. It's also important to note that this is an annual test, but a lot of people don't retire in January, and so for the first year of retirement, the first year of drawing Social Security, it is a monthly test rather than an annual test. The last point is that you need to understand and use the power of financial planning software. If you're watching this video, there's a good chance that you're smarter about your finances anyway than the average retiree. Some retirees, maybe even many retirees, don't do the work that you're doing right now. They don't watch videos, they don't listen to podcasts, and they don't do any reading on their retirement planning outside of perhaps a brochure that they have at the office when the 401k company comes in once a year. But as smart as you are, you can't do all of this work in your head. I would highly recommend that you find a financial planner that will allow you to use sophisticated software to bring this all together and take your big picture and give you actionable steps, what to do when, very specifically. By the way, there is the occasional commenter who will talk about how their financial planner took a modest $10,000 investment and doubled it or quadrupled it or created an avalanche of cash flow for them. You see it in the comments section below from time to time. When you see this happen, write down the name of the financial planner that they recommend and never use them. Instead, find someone you trust through family or friends or good old-fashioned research or a combination of all of those. And don't use anyone who's not acting in the capacity as your fiduciary. If they don't advertise that they act as your fiduciary, then they probably don't, because this is a smaller subset of financial planners out there. Oh, and the answer to the mind bender. What gets wetter and wetter the more that it dries? The answer is a towel. This is Jeff Schmidt. Thanks for watching.